The Ofgem announcement this morning placed a number on something the market had been pricing in fragments for weeks: household energy bills rising 13%, adding £221 to the average annual bill from July. The immediate FTSE reaction told a story of its own. Utilities fell, while the broader index only edged lower, suggesting the market had partly pre-positioned but not yet fully resolved what this cap means for the inflation path ahead. The mechanism runs directly through the Strait of Hormuz. Since the US-Iran conflict began on February 28, Brent crude swung from $70 to a peak of $126, before settling around $98 to $100, and UK petrol prices hit 159.43 pence per litre, the highest since December 2022. That supply shock did not stay in forecourt prices. It moved through wholesale gas markets, which feed directly into Ofgem's quarterly cap formula. And it is that formula, not geopolitical sentiment, that turned oil volatility into £221 of household obligation. What the surface reading misses is the asymmetry of the cap structure. Ofgem does not smooth shocks, it passes them through with a lag. The 13% rise announced today reflects gas prices from a period when ceasefire negotiations appeared more plausible. If the current deadlock persists through the summer, the October review will embed still higher prices. Foreign net selling in UK utility equities accelerated on the announcement, rotating into domestic institutional buying that was targeting the FTSE 100's defensives at a discount. The flow direction was clear. What remains unclear is whether the buyers were pricing a one-quarter spike or a structurally higher energy floor. The Chancellor extended the 5 pence fuel duty cut as a partial offset, and the government has emphasized cost of living measures, but those fiscal responses address the symptom rather than the cause. So long as the Strait of Hormuz remains partially closed to commercial traffic, a fifth of global daily oil supply, the cap mechanism will keep transmitting the same shock into the next quarterly review. The market is not yet pricing whether July's 13% is the ceiling or the floor. The Chapter 1 resolution leaves a structural gap. If energy prices are feeding through to household bills at 13% on the quarter, the standard transmission would lift consumer price expectations, press on real yields, and move gilt pricing. That did not happen. UK gilts were described as brushing off the energy cap rise. Yields held rather than spiked, and the 10-year gilt remained below the threshold that would typically accompany a supply-driven inflation shock of this magnitude. The unstated premise doing the heaviest lifting in the gilt market's calm is this: institutional buyers are treating the Iran war energy premium as a ceasefire reversible shock rather than a structural reset. The logic runs: oil at $98 is already discounting some Hormuz reopening probability. If a deal closes within the time frame that U.S. Secretary of State Marco Rubio described as a few days, gas futures fall, the October cap review normalizes, and the gilt market's present calm is vindicated. That is the premise. It is not stated in the gilt market's price action, but it is logically required for the yield hold to make sense at current levels. The competing frame, visible in the FTSE 100's divergence from European peers, where Germany and France fell while London edged up, prices the opposite: that FTSE's commodity and energy weighting acts as a hedge against a prolonged Hormuz closure, making the index structurally different from its continental counterparts in a way that justifies relative outperformance even as domestic consumers absorb the cap rise. Foreign institutional positioning showed net buying into FTSE 100 defensives and commodity names on Wednesday, consistent with that second frame. Both frames are simultaneously active in today's price structure. The gilt market's calm and the FTSE's relative resilience are not redundant signals. They rest on different unstated premises about the Hormuz timeline, and at least one of those premises will be tested at the next ceasefire checkpoint. The gilt market's verification point is the October Ofgem review. If gas futures remain elevated through June, the earliest practical window for a Hormuz flow restoration, the October cap will carry a second consecutive rise, and the premise underwriting gilt stability today will face a direct test from the formula that does not negotiate with sentiment. The gilt market's calm redistributes the question rather than resolving it. If sovereign pricing is not absorbing the consumer squeeze, something else must. And today's FTSE 250 gave the clearest read of where that absorption is happening. Hollywood Bowl rose 16.5%, the largest single-day gain among FTSE 250 constituents, on interim results that showed 2.6% like-for-like UK sales growth and spend per game up 7.6%. The CEO described the results as evidence of the business model's resilience against a challenging backdrop. That framing understates what the price action actually signals. Retail investors who had sold Hollywood Bowl down 28% over the prior 12 months were pricing the leisure operator as a victim of the cost of living crisis, the standard assumption being that discretionary spending collapses when energy bills rise. The 16.5% recovery on results that were decent but not exceptional implies that prior positioning had overweighted that victim framing. The repricing was not driven by the results alone. It was driven by the gap between where the stock was priced and what the results proved the consumer was actually doing. A family of 4 can bowl for £26 at Hollywood Bowl, materially cheaper than most competing leisure categories. At 13 times forward earnings with a 5% dividend yield post-rise, capital rotated into the stock from retail and likely some institutional value positioning that had been waiting for a results catalyst. The buyback announcement of £5 million for H2 and a 10% dividend hike added conviction to the positioning case. Filtronic's separate 4,622% 5-year run, driven by its SpaceX satellite communications contracts, shows that a different segment of FTSE 250 capital is chasing growth in defense and space. But that flow is a parallel story. Today's Hollywood Bowl move is more diagnostic of where domestic consumer discretionary positioning pressure actually sits. The monitoring variable is the October cap review coinciding with Christmas trading period, two forces hitting the same consumer simultaneously. If Hollywood Bowl's Q3 trading update in September shows that spend per game growth held despite another cap rise, the affordable leisure frame survives as a genuine structural tilt rather than a single results relief. If it reverses, the 16.5% recovery will look like a positioning unwind rather than a repricing of the consumer's revealed preference. That distinction, structural tilt versus positioning relief, is what the Gilt market's calm and the off-gem caps October iteration will ultimately force the market to resolve. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.